You've seen the headlines, right? A brand new love, a big retailer, maybe even a factory in your town suddenly shuts down. And somewhere in that story, you almost always see two words: private equity. And it kind of makes you wonder, what is it about this whole model that seems to go hand in hand with companies going under? All right, let's get right into it. To really get why this happens, you have to open up the private equity playbook. You got to look at the core strategies that drive this whole world of high-stakes finance. And that's exactly what we're going to do in this explainer. We're going to walk through that playbook step by step. So, every single game starts with the first play, the one that sets everything else in motion. In private equity, that move is called the leveraged buyout, or LBO for short. And you got to understand this because it is the foundation for pretty much every deal you'll ever hear about. So what on earth is a leveraged buyout? Well, the basic idea is actually pretty simple. A private equity firm buys a company, but they do it using a ton of borrowed money. It's kind of like buying a house with a really, really big mortgage. Same principle. But, and this is a huge but, there's a critical twist. And here is where your brain might just explode a little bit. See, when you buy a house, you are the one paying back the mortgage. But in a leveraged buyout, the private equity firm structures the deal so that the company they just bought is suddenly on the hook for all that new debt. It's like buying a house and then telling the house itself, all right, you're responsible for the mortgage payments now. It sounds wild, I know. So the process itself is a pretty slick four-step move. First, the PE firm picks a target. Second, they go out and borrow a massive amount of cash. Third, they use that cash to buy the company. And then here's the magic trick. They legally transfer that entire mountain of debt onto the company's own books. So right from day one, that business is suddenly in a way more fragile financial spot. Okay, so the company's been bought and it's already loaded up with debt. Now the clock is ticking. The private equity firm needs to make its money back and then some. And that brings us to the second plan in the book, extracting value, which, ironically, often means piling on even more debt. The toolkit they use is pretty straightforward. First up, you've got aggressive cost cutting. We're talking layoffs, slashing the research and development budgets, anything to boost profits in the short term. But the second tool, this one's a really clever piece of financial engineering you need to know about. It's called the dividend recapitalization. This whole move is, it's kind of nuts when you think about it. The PE firm basically tells the company it now owns to go out and borrow even more money. But that new cash isn't for new factories or cool new products. Nope. It's used to pay a giant one-time cash bonus, a special dividend, directly to the private equity firm itself. Let's jump back to our house analogy for a sec. A dividend recap is basically the same as taking out a second mortgage on your home. But you're not doing it to renovate the kitchen or fix the roof. You're just taking that borrowed cash and putting it right into your own pocket. Now, the house is stuck with two mortgages to pay off while you've already cashed out. And you can see the effect pretty clearly right here on this simple balance sheet. Before this dividend recap happens, the company has a certain amount of debt. But after, the debt load shoots way up, and the company's cash reserves are totally drained to pay out that special dividend. This is how wealth gets pulled out of the company, leaving it with way fewer resources if things get tough. All of these plays, all of these moves, they're all leading to one thing: the end game. Because you have to remember, private equity firms are not in the business of running companies for the long haul. Their goal is to buy a company, reshape it to maximize its sale price, and then sell it. And they want to do it fast. Their timeline is usually incredibly short. We're talking just 5 to 7 years typically. Year 1 is the buyout. The next few years are all about that value extraction we just talked about. And it all points to that one single goal, the exit, selling the company for a big-time profit. And this is where you see the fundamental conflict, right? The private equity firm is laser-focused on a quick, profitable sale. But the company itself, its employees, its future, its products, it needs long-term investment and stability to thrive. And a lot of the time, those two priorities are on a direct collision course. So here's where the risk really turns into reality. What happens if the company starts to struggle under that massive debt load? Maybe a recession hits or a new competitor comes along. Well, the PE firm's incentive might be to just protect its own capital, not to pour more money in to try and save the business. Sometimes that means just walking away, which can put the company on a fast track straight to bankruptcy. So when you lay out all the pieces of the playbook like this, a really clear picture starts to form.
You can see why this model is facing more and more scrutiny for the exact vulnerabilities it can create.
So let's just recap the big reasons. It's this perfect storm of factors. You've got that huge pile of debt from the very beginning, which makes the company fragile. You have a focus on short-term profits that can seriously hurt long-term health. You've got wealth being pulled out, leaving the company with less cash to survive a crisis. And maybe most important of all, when things go bad, the interests of the owner and the company can be completely at odds.
Which, of course, leaves us with a big central question here. Supporters of this model will tell you it's a brilliant and efficient way to make underperforming companies better and unlock hidden value. Critics, on the other hand, will argue that it just loads up companies with way too much risk, all for the benefit of a few investors. So the question I'll leave you with is this. Is this just a brilliant high-risk, high-reward strategy of financial engineering, or does it create a system that is, by its very design, just too fragile to last?